Well, welcome to your new home, Nadia.
For real estate agent AJ Valendu, the prospect of interest rate hikes has been spooking buyers.
We did notice a lot of buyers coming out to look at properties when there was that sort of expectation of interest rates to fall. But because they haven't actually fallen, just the number of the conversion of people looking to actually making offers and transacting has reduced.
After 13 rate hikes, AJ says he's seeing some signs of mortgage stress among those putting their properties up for sale.
Vendors will never tell us that they're actually forced to sell, so we have to sort of read between the lines.
And there's no sign of rate relief, with the fight against inflation taking longer than expected.
Things are pretty bumpy. We believe we have rates at the right level to return inflation to the target range next year.
The cash rate has been left on hold at 4.35% since November. Given the stickiest elements of inflation are essential services and demand for discretionary goods and services is already slumping, will any future rate hikes really be effective?
It's a good question. If other parts of the economy are resulting in inflation which is much higher, then we do need, it's the only tool we've got, but we do need to think about using interest rates to impact the parts of the economy we can impact.
Some economists believe the central bank missed an opportunity.
To hit the Reserve Bank's targets, you would think they would need to increase to get inflation back to 2.5% quicker than they're expecting.
I don't think that further interest rate rises from here would actually help to soften inflation.
The Reserve Bank admits household spending has fallen off a cliff.
What we are really trying to do is slow things enough to bring inflation down without tipping the economy into recession.
Treasurer Jim Chalmers had hoped to focus on spending in the budget to kickstart growth, but strong inflation has changed that.
The government needs to be running fiscal policy that's not adding to inflation. I think that there is also a case here to review the immigration numbers at the moment, to bring those down, to help the situation around housing supply and to reduce rental growth.
No one, not even the Reserve Bank, is certain about the next rate movement.
What they should do is increase rates. What they will do is sit where they are. The Reserve Bank waits till things are painfully obvious before moving.
AMP's Deputy Chief Economist Diana Musina thinks the economy will be much weaker in the next 6 months.
We think that the cash rate will remain on hold until the end of this year, and then we'll see an interest rate cut. So we are still looking for the next move to be down.
The Reserve Bank thinks it has interest rates at the right level, but they might stay there for longer than expected. Experts say homeowners should take advantage of the intense competition between banks to hunt around for a better deal.
You cannot rely on the RBA to hand out rate relief for you.
What should borrowers be doing now to ensure they're getting the best rate?
Borrowers should start preparing their finances now. And now a good way to do that is to pick up the phone to your bank and ask for a rate cut.
Sally Tyndall says borrowers could save thousands of dollars by refinancing.
There are 30 different lenders on our database that are still advertising at least one variable rate under 6%.
Switching now to save in the long run.
Nadia Daly there. The inflationary pressures on households were made abundantly clear by new retail sales data from the ABS. It revealed first quarter sales volumes fell by 0.4%. It's hardly a surprise. The RBA's latest statement on monetary policy identifies low and middle income households with large debts as those bearing the biggest burden. Business editor Michael Yander joined me. Hi Michael. This was an important update from the RBA. What are its main messages about the state of the economy?
Yes, the statement on monetary policy had the full range of the latest RBA forecasts, and the big change is in household consumption. It was already forecast to be very weak back in February when the Reserve Bank last did these figures, but now it's been downgraded further from 0.8% to the year to June to just 0.1%, so basically no increase in household consumption over the past year, and that's despite the population growing by at least 2%. So in per capita terms, we're seeing a big fall in how much households are consuming. The only reason economic growth, GDP, wasn't downgraded by more was a big increase in public demand, that is government spending at a federal and state level, a lot of infrastructure projects and social services spending, health, education, etc. And also business investment was slightly upgraded on previous forecasts. But really, the household sector is struggling, and these RBA forecasts confirm that interest rates are doing what's on the sticker, which is lowering demand for discretionary items.
And so what is the RBA most concerned about?
Well, despite that huge fall in household consumption relative to the levels we expect, I mean, the ABS figures out today show that it's fallen for 5 out of the past 6 quarters in terms of the actual volume of retail goods being sold. Despite all of that, inflation is being stubborn, and the RBA was forced to upgrade its inflation forecasts today. In the short term, it still expects, it maintained its February forecast of inflation getting back to target by the end of 2025 and back to the middle of the target by June 2026. But given the huge drop-off in household consumption, you'd expect inflation to be falling faster. But it's those essential goods and services that are really maintaining that price pressure, particularly things like rents, insurance costs, education costs, and other things that also have been linked to the inflation rate up till now.
Michael, the RBA's statement mentions the level of demand continues to exceed supply. What did Michele Bullock have to say about how much of that demand is due to the ongoing very high levels of immigration?
Well, she said basically migration is a double-edged sword for the economy. Yes, it does add to demand. It's one of the reasons that we're not in a technical recession, even though we're deep in a per capita recession and have been for more than a year. And that's just because more people equals more goods and services that need to be bought, even if each one of us is buying less. It is also propping up inflation, particularly, she noted, in rents. That's the main area where migration has exceeded the supply capacity of the housing market. But on the other hand, she said it has been putting downward pressure on wages, because all through the pandemic period and immediately after, the main complaint that the Reserve Bank was hearing from its business liaison is we can't get the staff we need and we can't provide more goods and services because we don't have enough skilled workers. Well, now, since the borders have reopened and hundreds of thousands of people have been coming in every year, migration rates are 2.5% population growth, businesses are now finding the workers that they need. So that's putting a cap on wage growth, which at 4% or thereabouts is about the highest level the RBA wants to see it before it causes more interest rate headaches.
Michael Yanda, thank you.
Thanks.